Welcome to this presentation on challenges to sustainable road freight transport in India. I am G. Raghuram, currently Principal Academic Advisor, National Rail and Transportation Institute. I have earlier been faculty at the Indian Institute of Management, Ahmedabad, and then the Indian Institute of Management, Bangalore. This presentation has three broad elements. First, diagnostics of the road freight sector in India, then the challenges, and finally, some conclusion. Under diagnostics, we will look at the share and significance, the industry structure, and a 5S framework that I have evolved. As we move to the challenges, we will look at the infrastructure, primarily roads, the vehicles, warehousing, and the driver. And finally, we conclude. Road freight has gained a strong foothold in India thanks to its basic offerings of door-to-door service and ability to handle smaller parcel sizes. I guess this is globally true. However, in India, this has to be set in the context of the Indian Railways handling of freight, which is really not being so customer friendly. That is, increase in parcel sizes due to insistence on rake load movement, where the focus is on efficiency at the cost of effectiveness. Minimum rake loads would be today of the order of 2,500 tons and going up to 4,000 tons, depending on the cargo. The second aspect of not being so customer friendly is there is a lack of agility due to being a large bureaucracy. Apart from not being customer friendly, the railways do have capacity issues on key routes where traffic is willing to come onto rail, but they are just not in a position to carry it. The net consequence is that the modal share has shifted in favor of roads. The railroad share has changed rather dramatically between 1950 and 2017. 1950 is just a few years after Indian independence, when rail formed the significant chunk of freight transport in India at 80% of the ton-kilometer share, with 20% for road. In 2017, when we have a reasonable guesstimate, if you will, rail has dropped to 35% and road is at 65%. The government looks at the contribution of the transport sector through the gross value addition, a parameter similar to the gross domestic product, that is the GDP. The transport sector has been close to 5% of the gross value addition of the country. And if you notice, in the past few years, it's been coming down from 5.02 to 4.85%, but a marginal reduction. For the year 2016-17, the 4.85% breaks up as 0.77% for railways and 3.12% for road transport. There is a bit for water, air, and value addition due to services incidental to transport. While the ratio of road to rail in ton kilometers, remember the 65 to 35, is about 1.9, the ratio in terms of value addition, that is in monetary terms, is 4:1. In other words, even though freight charges are higher, the total logistics cost by road is viewed to be lower than by rail by customers. As a share of the overall economy, road transport as well as overall transport is marginally reducing. There is a possible data problem since air transport share is being shown as having gone up substantially either due to an error or a reclassification. The increasing volume and modal share of road freight in India is complemented by a fragmented industry structure. The industry structure has disaggregated ownership and has a separation between ownership and marketing. This really does not augur well. If we look at the ownership profile, again here this data is largely a guesstimate based on samples at different points of time. I think the last time a reasonable assessment of this was possibly made is in 2010, and many have been quoting this. The ownership with just 1 to 5 trucks constitutes 75% of the fleet, with 6 to 20 trucks constitutes 15% of the fleet, and with 10% of the fleet accounting for those owning 20 or more trucks. So large fleet owners, where we are even putting the bottom at 20, just account for 10% of the fleet. It is possible that since 2010, the numbers have changed somewhat in favor of the more than 20, because many of the second generation fleet owners or the younger promoters who have generally had a better education are looking at increasing their fleet size and have been reasonably successful at doing so. Let's look at the industry structure that brings out the ecosystem of road freight. As core actors, of course, we have the customers, we have trucking companies, we have brokers and agents, and we have pure truck owners. This reflects the difference between trucking companies who provide the marketing front and the truck owners. Some truck owners attach their trucks directly with trucking companies, but most go through brokers and agents for the trucking companies. Of course, some brokers and agents also directly deal with customers who through them then get access to pure truck owners. Then there are tangible elements. We have manufacturers, truck body builders, drivers, fuel suppliers. In India, most of the trucks today are still manufactured just as a chassis, and then they go into small and medium enterprises for truck body building. Tatas and Leyland have traditionally been doing this. These are the big players. Some of the new players do provide an integrated body built truck like Volvo, Mahindra. Of course, we have drivers, fuel suppliers. Then support services, which is sort of true anywhere: financing, insurance, maintenance and repair, food and stay, IT services and associations. And then, of course, the government and regulatory bodies, the regional transport office for licensing of vehicles and drivers, tax administrators, traffic police, road development authorities, the center where there is the Ministry of Road Transport and Highways, and then states who also have road transport ministries. Government policy and regulation is an important influencer of this sector. There are regulatory checkpoints, even though reducing after introduction of the goods and service tax. Many states still would like to know what goods are coming in so that any of state-related issues can be dealt with. With increasing information technology and documentation around it, this should reduce. We then have the Motor Transport Workers Act, which specifies duty hours, rest requirements, etc., but violated in a significant way by the owner operators, that is the truck drivers who own their own trucks. There are financing incentives for small size truck owners by the government provided through banks. Both the Motor Transport Workers Act and the financing incentives, in a sense, collude together to ensure that the industry structure remains largely with small fleet owners. Otherwise, it would be difficult to fall in line with the Motor Transport Workers Act and be able to enjoy the financing incentives. We then have the Motor Vehicles Act, which does the driver's licensing, overloading, emission norms, etc. These also sometimes get violated. Well, we have the frontline regulatory functionaries who tend to compromise on policy implementation. The core attributes and externalities of the road freight sector. We look at attributes. There is price-based competition. In fact, there is a dog-eat-dog competition, and therefore, for getting any margin, almost every trucking company or truck owner has to see how to keep transport costs low. This results in poor logistic service quality, and aided with a no commercial entry barrier, the industry really is very competitive. This results in truck owners showing behavior of overloading of vehicles, poor truck maintenance, and willing to give side payments to the regulatory frontline staff just to get their way through when they don't follow rules. Trucking companies hire on lowest rates and do not sufficiently monitor the supply side service quality. This results in the shipper really not having a choice, who then consequently focus on direct transportation cost only, or at least most of the shippers, rather than on the value they derive from road transport. So this has a reduced expectation from the service provider. And all this then results in induced externalities of safety, lots of accidents due to trucks. India has amongst the highest accident rates in the world, pollution and damage to roads. The unholy equilibrium, one can see the relationship between different actors, government policy, the frontline regulatory functionaries. So the government policy results in the industry structure, which then results in a behavior of the truck owner, the trucking company, which results in the core attributes that we talked about. And because of the prevalence of the core attributes, the shipper's expectations are also moderated, and we have the consequence of induced externalities. This leads to concerns which we conceptualize into 5 S's: safety, security, stresslessness, sustainability, and speed. In how much time do we actually get from wherever to wherever? If we wish to address the concerns, the first challenge one faces is that of reliable data, either for policymakers or for shippers or trucking companies. There is no data on origin-destination flows for the trucking sector, and consequently, a reliable estimate of total ton kilometers. Even the earlier ton kilometers modal share between rail and road is at best arrived at by a guesstimate of road ton kilometers using sample data and aggregate validation through surrogates like diesel and tire consumption. A decadal sample survey has been carried out since the 70s to assess road movement. The last available published data is of a survey carried out in 2007-8. The results of this are that road had a total billion ton kilometers of 706, accounting for a share of 50.11% of the total domestic movement. Rail, pipeline, coastal and airways are from the organized sector and the data is fairly reliable. Inland water transport again comes from the semi-organized sector and one is not so sure about it. So road and inland water transport are the ones where the data reliability is in question. And for road, the issue is far more significant because it is the largest mode. So in 2007-8, the road share was about 50% of domestic ton kilometer movement. Between rail and road, the share was 42:58. Based on assessed growth rates linked with GDP growth, it was estimated that in 2016-17, the share would be 35:65. The National Transport Development Policy Committee has tried to estimate the overall freight traffic until 2031-32 using a growth rate of 1.2 times the GDP growth rate, which is considered desirable for a developing country like India. Further, an intervention to ensure a higher modal share in favor of rail has been considered. Based on this multiplier of 1.2 and assumptions on GDP growth, the projection of freight traffic, the total freight traffic in the country has been 2,000 billion ton kilometers in 2011-12, going all the way up to 13,000 in 2031-32. With a further intervention of trying to increase the rail share from 35% to 50%, we get a possible projection of road freight in billion ton kilometers, starting with 1,000 billion ton kilometers in 2011-12, nearly 2,000 in 16-17, going all the way to over 6,000 by 2031-32. This starts with what is a reasonable guesstimate of 700 billion ton kilometers in 2007-8. It is expected that by now we would have crossed 1,500, even though by 16-17 it was supposed to have been nearly 2,000. And so it remains to be seen whether we will be anywhere near the 6,000 plus by 2031-32, and in fact, over all the intervening years. It is now expected that the GDP growth rate, the multiplier of 1.2, and the expectation, even through policy interventions, of a higher rail share are all overestimates. While the first two would cause a reduction in the expected road movement, the third would cause an increase. This leads to a set of challenges to enable the road movement. The challenges we look at under infrastructure, that is roads, vehicles, warehousing, and of course, the driver. In terms of roads, the national highways constitute a little under 2%, and rural roads today constitute about 70%. Of course, between 2015 and 2017, there was a reclassification of some of what were called district roads or other district roads into rural roads, and hence that number has shot up. Rural roads are being improved and provide much needed last mile connectivity. The important thing is the focus on the national highways and state highways, where a large part of the truck movement happens. In terms of categorizing of the national highways, which is now crossed 100,000 kilometers, about 25% is less than 2 lanes. So it's one or a little wider than one to enable overtaking or crossing in a careful way. 2 lanes are the bulk at 51.6%, and 4 and above have reached 23.1%, a significant increase over the last couple of decades. With nearly 6 million kilometers of road length, India is the second largest in the world after the USA. However, in terms of road density on an area basis, we are at 1.8 kilometers, which compares favorably with developed countries. Remember, the US, the area is 3 times India. On the other hand, road density on a population basis does not compare favorably given India's high population. It is 4.87 kilometers per 1,000 population. An interesting opportunity when we look at the data is that 40% of the ton kilometers move on the national highways, and a similar significant number move on the state highways. So PPPs, that is public-private partnerships, have become a significant source for developing national highways and major state highways, including some as expressways. There is also a big thrust on increasing the share of all-weather rural roads, which will provide last-mile connectivity. The road development is expected to have a positive impact on speed and safety. The average kilometers per truck per day on long-haul movements is estimated to have increased from 275 kilometers per day to 375 kilometers per day over the decade. Some trucking companies also claim to have crossed an average of 500 kilometers per day. Going on to vehicles, India today has, or at least in 2017, has 253 million vehicles, showing a growth rate, an annual growth rate of 10% over the 2007 to 17 decade. Two-wheelers, of course, form the big chunk. However, focusing on goods vehicles, we see that from 2011 to 17, we have gone from 7 million goods vehicles to over 12 million goods vehicles at a 9% compounded annual growth rate. We can look at the breakup of goods vehicles. where we have multi-axled and articulated vehicles accounting for over 1 million, the sort of standard trucks accounting for over 4 million, and then the light motor vehicles accounting for close to 7 million, which brings the total to over 12 million vehicles. We have data here on what share of them are commercially available, that is through third parties. What is not available to third parties are owned by companies who have their own fleet for moving their goods. Only 46.5% of the total goods fleet are used commercially in a third party sense. The commercial use in the LMV segment, which is the largest segment of the total fleet, is only 29%. To the extent national permit is required for cross-country movement, only 20% of the commercially plying vehicles have a national permit. This further accounts for only 9% of the total goods vehicles. Thus, 9% have a national permit. The share of heavy axle vehicles is going up, as also the light motor vehicles. Better truck design is targeted at sensors for vehicles. Most fleet owners today would know the location of their trucks on a real-time basis, and to some extent goods tracking. Designs are yielding better driver comfort, more fuel efficiency, and reduction of emissions. In fact, reduction of emissions is also a consequence of regulatory requirements. This is expected to improve security, stresslessness, and sustainability. Warehousing is another critical aspect. Modern warehousing is coming in through public-private partnerships, a significant amount in the agricultural context, and then e-commerce. Then we have inland container depots and container freight stations to move containers for the manufactured goods, and we have multimodal logistics parks. All this is likely to reduce the overall road freight movement, and within road freight, increase the multi-axle and light motor vehicles. Why would it reduce the overall road freight movement? Because some of these locations would enable easier aggregation and disaggregation to move onto rail. Then looking at the driver, driving is culturally not viewed as a self-respecting profession. Consequently, availability of drivers is an issue. Increasingly, trucks idle for want of a driver. There are companies who are experimenting with change of driver versus the same driver on long-haul routes. The experiments on change of driver, however, has not penetrated the larger road freight ecosystem. Even in time-definite cargo movement, the two-driver model is more prevalent than change of drivers. While there is talk of improving facilities for drivers on long-haul routes, both the expectations and service are not up to the mark. Coming to conclusions, the outlook for road freight to be an economically sustainable mode is positive. The same, however, cannot be said on environmental considerations. If policies are right and implemented well, rail share can start increasing, though it cannot become the primary freight mode. There is significant room to improve service parameters for road freight movement. Scale of fleet ownership to reduce the fragmentation, branded play, and developing niche markets would be the way to go. Many of the younger promoters of trucking companies are quite conscious of this. And finally, policy and cultural changes remain to be effected. Thank you.